Today, we're putting the spotlight on a strategy that's close to every investor's heart, dividend investing. Stay tuned as we unveil our carefully selected top 5 dividend stocks for 2023. If you're looking to build a steady income stream while growing your portfolio, you're in the right place. Let's get started straight away. Starting with our first selection is Chicago Atlantic Real Estate Finance, Inc., with the ticker symbol REFI. Chicago Atlantic is a commercial real estate finance company that's making waves in the cannabis space. They manage a diverse portfolio of real estate credit investments, focusing on the cannabis industry. With a seasoned management team at the helm, Chicago Atlantic knows the ins and outs of real estate credit, lending, and risk management. So, why is Chicago Atlantic a top choice for dividend seekers? Let's break it down. The cannabis market is booming, and Chicago Atlantic is strategically positioned to capitalize on it. As cannabis legalization sweeps across states, operators need financing for expansion, and Chicago Atlantic is there to meet that demand. Due to federal restrictions on cannabis, Chicago Atlantic enjoys a relatively limited competition environment. This gives them an edge in the market and positions them as a premier lender to top players in the cannabis industry. When it comes to financials, Chicago Atlantic doesn't disappoint. Revenue growth, an impressive 16.16% growth, shows their ability to capture market opportunities. Earnings growth, a solid 16% growth in earnings, reflects their financial stability. Operating margin, a healthy 70% operating margin, underscores their efficient operations. Payout ratio, while higher than 100%, the 106% payout ratio indicates a commitment to rewarding shareholders. High dividend yield, and here's the kicker. Chicago Atlantic offers an outstanding dividend yield of 13.3%. That's well above the average and could make your investment portfolio smile. Financial strength. With a debt-equity ratio of 0.15, Chicago Atlantic is maintaining a healthy balance between debt and equity, indicating financial prudence. Let's take a quick look at its financial figures. Market cap at the time of recording this video was approximately $257.5 million. Last 12-month earnings, around $36.3 million. Last 12-month revenue, approximately $52.2 million. Price-to-earning ratio are reasonable at 7.1 times, and price-to-sales ratio of modest at 4.9 times. In a world where finding reliable dividends can be a challenge, Chicago Atlantic Real Estate Finance stands out. With their strategic positioning in the thriving cannabis market, strong financial indicators, and an impressive dividend yield, this could be a solid addition to your investment portfolio. Next on our list is oil and gas major ExxonMobil. This company is a global energy powerhouse engaged in the exploration and production of crude oil and natural gas. Headquartered in Irving, Texas, the company operates across 4 main segments: upstream, energy products, chemical products, and specialty products. Let's break down each segment. The upstream segment goes after crude oil and natural gas, playing a vital role in ExxonMobil's operations. The energy products segment of ExxonMobil provides fuels, aromatics, catalysts, and licensing services to power industries around the world. The chemical products segment manufactures petrochemicals like olefins, polyolefins, and intermediates. The specialty products segment manufactures performance products like lubricants, waxes, elastomers, and resins. Now let's take a look at the numbers that stand out. Revenue growth. With a whopping 44.2% growth, ExxonMobil is showing its ability to expand its top line. Earnings growth, reported a staggering 146%, speaks volumes about the company's profitability. A healthy 17.8% operating margin signals efficient operations. ExxonMobil offers a dividend yield of 3.4%, making it an appealing choice for income-oriented investors. Let's break down Exxon's financials. Market cap at colossal $432.7 billion with robust earnings of $51.72 billion. Its revenue stands at a substantial $367.98 billion. Exxon's price-to-earnings is reasonable at 8.4 times with price-to-sales ratio at a modest 1.2x. Exxon has maintained a conservative 20% debt-to-equity ratio. Why you should consider ExxonMobil. ExxonMobil boasts strong growth, solid earnings, and a dividend yield that's certainly attractive. If you're on the lookout for a sturdy company with a long history of success in the energy sector, ExxonMobil is worth a closer look. Next on our list is Cal-Maine Foods, a key player in the food products industry. Let's dive into why Cal-Maine could be a hearty addition to your dividend menu. Cal-Maine Foods takes center stage in the production, grading, packaging, marketing, and distribution of shell eggs. With a history dating back to 1957, this Mississippi-based company offers an array of specialty shell eggs that cater to diverse consumer preferences. Cal-Maine Foods serves up a variety of specialty shell eggs, including nutritionally enhanced, cage-free, organic, free-range, pasture-raised, and brown eggs. These eggs don various brand names like Eggland's Best, Land O'Lakes, Farmhouse Eggs, Sunups, Sunny Meadow, and 4-Grain. Now let's crack into the impressive numbers that Cal-Maine brings to the table. The company's revenue growth has soared by a remarkable 77% year-over-year. That's some serious expansion. Cal-Maine's earnings have surged by a jaw-dropping 401% year-over-year, a strong sign of financial health. With an operating margin of 30.6%, Cal-Maine is efficiently managing its operations. The dividend yield is a mouthwatering 11.1%, making this stock quite appetizing for dividend-focused investors. Let's scramble through some financial figures. The market capitalization at a substantial $2.3 billion. The latest 12-month trailing earnings at an impressive $756 million. The latest 12-month trailing revenue stands at $3.15 billion. Speaking about valuation, the price-to-earning ratio is reasonable at 15.9 times, with price-to-sales ratio modest at 1.19 times. Last but not the least, an impressive debt-to-equity ratio of 0%. Cal-Maine Foods holds a strong position in the food industry, with eggs being a staple in many households. Their impressive revenue and earnings growth demonstrate their ability to capitalize on consumer preferences. Moreover, their robust dividend yield could make your investment strategy strong. In conclusion, if you're hungry for a solid dividend yield and are intrigued by the food products industry, Cal-Maine Foods could be an excellent choice. But remember, like any investment, it's essential to do your research and consider your financial goals. Number 4 on our list is from oil and gas sector, the Pioneer Natural Resources Company. This company is an independent force in the oil and gas exploration and production industry. Headquartered in Irving, Texas, this company zeroes in on developing and producing oil, natural gas liquids, and gas. Their operations are centered in the prolific Midland Basin in West Texas. Let's break down why Pioneer Natural Resources deserves your attention. The revenue growth at mighty 36.5% year-over-year growth shows their ability to scale up. An astounding 201% year-over-year earnings growth signifies robust profitability. Furthermore, with an operating margin of 40%, Pioneer Natural Resources is efficiently managing its operations. Their dividend yield stands at a compelling 9.9%, making this stock quite appealing for income-focused investors. Examining the financials, we find a substantial market cap of $54.5 billion, robust earnings at $5.8 billion, and hefty revenue of $20.39 billion. Additionally, an attractive PE ratio of 9.9x and a modest PS ratio of 2.6x, coupled with a comfortable 26% debt-equity ratio. If you're seeking a solid company in the energy realm, Pioneer Natural Resources could be worth considering. Remember, investing involves risk, so always do your research and assess your investment goals. Last on our list is Enterprise Products Partners. This company is a powerhouse in midstream energy services. With a headquarters in Houston, Texas, they provide essential services to both energy producers and consumers. Their expertise spans natural gas liquids, NGLs, crude oil, petrochemicals, and refined products. Enterprise Products Partners operates across 4 key segments, namely NGL pipelines and services, crude oil pipelines and services, natural gas pipelines and services, and petrochemical and refined product services. Their reach spans gathering, transportation, and storage of critical energy resources. Here are the financials to look into. A robust 42.6% year-over-year revenue growth is a clear sign of their upward momentum. Its respectable earning growth of 18.6% year-over-year earnings growth underscores their financial health. Furthermore, with an operating margin of 11.1%, Enterprise Products Partners is navigating their operations efficiently. Finally, offering a dividend yield of 7.6%, This stock holds a lure for those seeking regular income. Let's check out the financial figures. The market capitalization of a substantial $57.1 billion and solid earnings of $5.4 billion. Furthermore, revenue for the last 12 months was reported at $52.2 billion. The price-to-earning ratio is compelling at 9.74 times. The price-to-sales ratio at modest at 1.18 times. Here is the red flag: debt-to-equity ratio of 103%. In our view, for investors looking for midstream energy exposure, Enterprise Products Partners could be an intriguing option. However, it's crucial to carefully consider their debt situation before diving in. Always conduct thorough research and evaluate your investment objectives. Thank you for tuning in to our top dividend stocks for 2023 video. If you found this information valuable, please consider hitting that subscribe button to stay updated with our latest investment insights. Your support means the world to us.